So in this project that you're going to be working on, there is one change to the annual reports that you will be looking at for this second FRP, the second part of your financial reporting project. Again, the point of the financial reporting project is for you to see what you're learning in this class is actually applied in the real world. These are financial statements that are actually filed with the Securities and Exchange Commission. So all companies are reporting what's their, guys, over there. There. All financial statements have to be reporting their information under generally accepted accounting principles. So this second FRP, I'm having you guys look at ratios. I don't have you do them on tests. I don't normally have you do them on a lot of homeworks. I actually have you do them on the financial reporting project because you can make conclusions and look at trends based on what these financial reporting projects information is giving you. So we are going to be using the most recent annual report. Now, most companies that have a year end of 12/31 have to file annual reports 2.5 months, at least 2.5 months after their year end. If they do not file their annual report within 2.5 months of their year end, if they're publicly traded, they would be ceased to be trading on the stock market. So the SEC would actually stop their ability to trade because they're not in compliance with the government standards that are needed. So since that first financial reporting project we've done, the newest annual reports are now out for Abercrombie and American Eagle. So for instance, if I'm looking at Abercrombie's most recent balance sheet, I will see that the date is listed January 28th, 2017. Notice that it also has the prior year information. If it says January 28th, 17, what year does this column represent? 2016. Therefore, what does this column represent? 2015. So you're going to be pulling up the current statements, and hopefully you already also have the 2015 statements saved already from that first annual report you did, because you're going to need both of those reports. In this project, the first thing you're going to be looking at is the current ratio. Now, I give you the page number, the reference in your book. Starting on page 765 of your textbook, and you can see this is actually posted up on Moodle, this FRP project. On page 765 of your textbook, it gives you a couple pages of ratios. That's what you're going to use to do the majority of this project for ratios. The first ratio is the current ratio. And for those of you that did the homework on Chapter 9, which dealt with the classified balance sheet, does anybody remember what the current ratio is? I believe that it was talked about in that video. Current ratio. It's looking at your current assets and comparing that to your current liabilities. So I'm giving you an example here from American Eagle. So at American Eagle, their current assets compared to current liabilities gives them a current ratio of 1.8. And when you read your textbook, it says any current ratio over 1 is considered a good ratio. What does that mean? Looking at that information, what does that mean? Any number greater than 1 is considered good. Yeah? So when we're looking at classified balance sheets, we're looking at current versus non-current. So if you have current liabilities, that usually means that they are due to be paid within this year. Now, if you see that your current assets are lower than your current liabilities, would you think you could potentially have a problem paying your current debts when they come due? Yes. So I'm asking you to look at the current ratio for two companies. And we're looking at ratios because it's pretty hard to compare companies based on dollars. One is in millions, one is in thousands. So it's pretty hard to compare based on dollars, absolute dollars, but you can compare based on percentages, ratios. So I'm having you do that. When you look at Abercrombie, your information, again, your financial statements. When you're looking at a 10K or an annual report, the financial statements are always together. What are the four main financial statements that you look for that are always together when you're doing the annual report project? What are the four basic financial statements that have to be together? Here's one. The balance sheet. What's the next one that you might see? Income statement or statement of operations. What else might you see? Cash flow. And the other one? Statement of stockholders' equity. So the first thing you're trying to do is you scroll through, and your financial statements are usually the last thing in the annual report. The first part is the management's discussion and analysis, which is just management talking about their operations. We care about the auditors' financial reports that they have given an opinion on those reports, saying, we've audited these numbers and they don't appear to be materially misstated in any way. So basically saying that users of these statements should be able to rely on them when making a decision. So looking at the consolidated balance sheet, when you're trying to get your ratio analysis, your information you're going to be using is coming from the balance sheet and the statement of operations. Those are the two statements you'll be using, balance sheet and statement of operations. Why does it say consolidated again? What does that mean, consolidated? Yeah. You got it. So all the brands that Abercrombie has, they're all added together, consolidated into one financial statement. We don't have separate financial statements for each one of Abercrombie's brands. They all are together because they're wholly owned by the parent company, Abercrombie & Fitch. So looking at this information, if I was trying to figure out the current assets for Abercrombie, I would just literally look at total current assets. So total current assets, is this $1,139,300? Is that what it is? 1 million? How many zeros do you have to add if it's thousands? So this doesn't represent 1 million. What does this represent in assets? $1 billion. When you're doing the financial reporting project, you'll notice that I don't say that you have to add zeros here because it's not going to change your ratio to just add zeros. So all I really care about is that you do the right, you put the numbers down. You do not have to add zeros, but just remember, when you're reading this, it's not that they have 1 million, they have $1 billion. So it's just something for you to remember, to think about, especially when you're comparing it to American Eagle. Are they in billions or are they in millions?
Do any companies have quadrillions?
No, I have not seen that.
You sure?
I haven't seen it. There could be. Maybe find some and then we can show some in class. I have never looked for that, but I can't tell you. I just have not seen it. Trillions? I don't know.
I said quadrillions.
Yeah, I don't know. What even is that? I don't even know. Other things that you'll notice here, when you get to number 4, it says find the percentage change. So find the percentage change in sales. So find the percentage change in sales total. And I actually tell you how to calculate that because it doesn't show you how to do that in the back of your book on page 765, 764. So on the last page here, because a lot of students don't even look at this, you'll see that I actually give you the horizontal analysis. So you're taking a current year. So you'd be taking the 2016 information, and you're subtracting the prior year information and dividing by the prior year to find out what's the change in the current year. So you're looking at current versus prior and trying to figure out what percentage change is it. So remember, it's important to find percentage change versus a dollar change because we can't compare companies dollars-wise if one is in millions and one is in billions. So you can find the percentage change just by taking current minus prior divided by prior year. So I literally tell you exactly how to do it. And all I'm asking for is look at sales. So what's the current year sales minus prior year divided by prior? What's the change in sales for Abercrombie compared to the change in sales for American Eagle? Then I'm going to ask you to do what's the percentage change in gross margin? What's the percentage change in net income? So what's the percentage change in what's net income? And then underneath that, I would like you to look at those three different changes and try to say, who do you think is doing better and why? Are one of these a better indicator of performance than another, or do you have to look at them all together? And again, when you go through and look at what does gross margin mean, you can find out that information just by looking in the back of that text. Additionally, when you get past number 6 and you get into number 7, you're going to be asked to look at the footnotes. So you're looking at the balance sheet and footnotes. Where are the footnotes again? Anybody remember where the footnotes are? They are right directly in the back of the financial statements, the 4 basic financial statements. So for instance, this is page, so the Abercrombie balance sheet, that's page 42. There you go. The footnotes start on page, one of the footnotes starts on page 46 for Abercrombie. So you can see that they're talking about footnotes. It says notes to consolidated financial statements. So I tell you exactly what to look for. You have to use that information. One of the things that we've been learning about, and I mentioned before, was the use of estimates. So you're using estimates in this class. Do you understand why you're using estimates? I want you to find this information, and I want you to tell me at least one account that's an estimate from what you've learned. So this is taking stuff we've been doing in class and trying to incorporate that. I'm also asking for things such as, look at the cost of goods sold footnote. What do they include in cost of goods sold? So the information that we're actually learning, you're seeing that they actually do that. And they go into more detail than what we do in this class. A lot of this financial statement information is very complex. It's stuff that you would learn in a higher level accounting course. It's things that you would learn if you're out there in the field working. But regardless of what major you're in, if you don't understand the basic stuff about accounting, it makes it nearly impossible to succeed out in business, no matter what position you're in, marketing, management, OIM, finance. Additionally, one of the things companies need to do is they need to say what their advertising expense is. So again, looking in the financial statements and saying, what was their advertising expense? What did they do to advertise? And you'll find that it's a pretty large number for companies. I'm also asking for what methods of depreciation do they use. So you'll see that what we're doing, you actually, they are using those. And then the inventory footnote, what type of inventory methods do they use? I also have you looking at the cash flow statement. So here on number 12, I say using the cash flow statement, explain to me what they have for capital expenditures. What's a capital expenditure? Somebody give me an example of a capital expenditure. We just spent 2.5 days doing it.
Equipment like machinery.
Yeah, equipment. Long-term assets that you buy. So how much does the company actually spend in cash on capital equipment? The other thing that I'm also going to have you guys do is look a little bit more closely at the retained earnings section. So the statement of owner's equity, I'm going to have you look at that section in a little bit more detail. And one thing that is not on the FRP that I'm going to give you here in class is some key numbers. So this is not on the FRP, so this is only here for you guys in class. When you look at the financial statements, let me actually pull one up for you. You will see that the statement of stockholders' equity looks quite different than what you guys have actually done in the past, than what we've actually looked at. Everybody got those numbers down that wants them? Write them down because I'm going to pull up the financial statements so you can see that, where I got those numbers from. So we're Abercrombie. I'm sorry. Abercrombie. So I'm going to pull up Abercrombie's financials. Here we go. Two. All right. Everybody's got them. So, Abercrombie. I'm going to make this a little bit bigger so we can, oh, you can't even see it. Okay, so this is the statement of shareholders' equity. So I'll just show you the name of the title here. Consolidated Statement of Stockholders' Equity. I've made it a little bit bigger. So this is the total statement here. We're just wanting to look at retained earnings, but you'll notice they have common stock information, paid in capital that we'll learn in Chapter 11. We won't learn anything about non-controlling interests. And then retained earnings is a column here that I'm caring about. Notice that it starts, and the way that this works is that it starts with the oldest year first and works its way down to the newest year, or the most current balance. So I'm not asking you for 2013 information, which is the 2014 balance there. You're going to go down to the very last information here, which would be balance as of June 30th, 2016, which is really the 15 numbers, right? And we can see what the beginning balance was. Balance January 30th, 2016, 2,500, and again, 2,530,196. Now, the question is this really just millions? Again, most likely these are truncated numbers. So you can find out what that is by looking above, thousands. So again, this is actually not just 2 million, this is 2 billion. So there's that beginning number. Balance January 30th, 2016. So 1 year's ending is what for the next year? The ending is the same as the beginning, right? So that's the end, and that's the beginning place for the next year. So you can see things that have happened in here. What are the things that affect stockholders' equity? Retained earnings, most specifically. What affects retained earnings? Net income, right? Yes? Yes, so we see net income. Net income was not 3,956. It was actually what? 3,956,000. So in this, you must add the zeros, which is what I did on the FRP. What is the 54 million negative? What does that 54 million negative represent? Guys, What does the 54 million negative represent? It says it. Just say it out loud. Dividends. Dividends. 54 million. Is that something you normally see in stockholders' equity? Yes or no? Yes. Under retained earnings, what is retained earnings reconciliation? Refresher. Beginning balance plus what? Okay, so remember, we're under stockholders' equity. We're looking at the retained earnings. And retained earnings, beginning retained earnings plus net income. Remember, revenues and expenses are only listed on the income statement. We only see the word net income on the retained earnings statement. After net income is added, what else is subtracted normally? Dividends. So we can see the dividends are also subtracted. And in this situation, you also have another negative. All I need you to do is write down what that is. They gave out stock compensation. They gave out compensation that was stock to shareholders, to employees. So that's another $5 million that decreased their retained earnings. And then you can see what's the retained earnings ending balance. So there's more than just net income, and this segues into what we're doing today as well. There's more than just net income in retained earnings. In this situation, they actually gave out compensation for to individuals, employees, in the form of stock. And that affects retained earnings. That's, again, another higher level thing that you would learn. But it's important because when you look at your financial reporting project, it says plus. So here's your starting point. Make sure that you add your zeros. So make sure that you add your zeros. This one is for Abercrombie, which we just had showed up there. Add to it net income, subtract dividends, and this says plus or minus other. So what would the plus or minus other for Abercrombie be? Stock compensation. That makes sense? You just have to make sure the beginning balances down to the end. So there is a formula in here in Excel. So when you put the numbers in, it should actually work and show that to you. So prove to me that it works. So that's an answer for you here in class that you won't get otherwise. Any questions on that? No? Awesome. In class, yeah. What's that? Yeah, you're going to be doing gross margin. So you'll see them all on here when you open up the FRP online. They're all the current ratios. So you're looking at them for more than a year. So you're trying to find the trend. I think that's what you're saying. So after here, is that what you're saying? So this is Abercrombie's 2016, 15, 14. I'm looking for a trend. So I give you this information up here. So I'm looking for a trend. Are they on the upswing? Are they on the downswing? Or are they kind of like all over the place? And then you're going to look at this information and conclude, based on the current ratio, who's more liquid. So who has more assets than liabilities. And that's why you'll need the 2015 annual report to get this column. Because the 16 will have these two. You just need to use your prior one to get this column. Awesome question. Any others? Likewise, you guys did a 4-minute and 55-second video on classified balance sheets. So I'm going to test to see what you guys actually have learned from doing that. So get out your eye clickers. See if we need to talk about things in a little more detail or not. So, where would you find the following on a classified balance sheet? A fair 5-year note payable that's due in 8 months. Where would it be listed on the classified balance sheet this year?
Jack, my name is Jack McDonald, and I forgot my eye clicker, but the answer is C.
What? Better hope he's right. You got me. That was good. Everybody good? Did everybody put C? Not everybody was in agreement there. I don't know. All right. What do we have here for an answer? Well, what's your name again? Jax, yes. Yes, Jackson, you are correct. It is a current liability. Yes.
But it says that a long-term liability is anything that was longer than a year or more.
Yes.
It says 5 years. So, like, it would have made more sense if you said when we dropped it over.
So this is where the little tricks come in, okay? This is where you take what you read in your chapter and you listen to me in class and you get a little bit more information to make sure that you can actually answer any question that might pertain to this. So, in a classified balance sheet, you only classify something as a current asset or current liability if what happens, or if what rule applies, if what term is in existence. If it's an asset, it's current. Under what condition? We're going to use it, consume it, or sell it in a year or less. Likewise, in order for something to be a current liability, what does that mean? It is expected to be paid within a year. For you to classify something as long-term for either an asset or a liability, what does that mean? A long-term asset. What's the only long-term asset that you guys really know about right now? Property, plant, or equipment. Why? Because it lasts more than a year. That's a long-term asset. It lasts more than a year. And a long-term liability is something that is due in more than a year. So, when you have a situation where you have a note payable, the original term was 5 years. How has it been classified for years 1, 2, 3, and 4? How is it classified for the first 4 years? Long-term because it's due within 5 years, right? Hold on, let me answer. When it becomes less than a year that it's due, or a year or less, what do you think needs to happen to that? Should it still stay in long-term? It's when you watch that, remember that these are classified as long-term if it's happening within that operating cycle. If it's not happening within that operating cycle. So therefore, if the payment is going to be happening within the operating cycle, it needs to be classified as current in this situation. So this was originally a long-term debt, a long-term liability, but the minute it becomes 1 year or less due, you have to classify it as current because that affects your current liabilities, your ability to pay that within that year. So if you just leave it under long-term because it originally was long-term, you're never going to be comparing that with your current liabilities, and your current ratio may be very off. So you have to look at the details. Don't just see it's a 5-year note payable and say, oh, long term. It's due within less than a year, so now it has to be classified as current. Likewise, in this class, we've really only been talking about things, for instance, notes. We say the note's always paid at maturity, right? So we don't have to deal with current payments of principal and interest. We just say it's all due at maturity. The reality is there's always something that's due. Usually you make payments monthly on loans, and you pay interest and usually monthly. So pretty much every single financial statement I've ever worked on with a client that has had long-term liabilities, they've always had to classify at least that current year that's due as a current and the rest of it as a long-term. So for instance, if we just took this out, it's a 5-year loan, and we just took this out this year. On my financial statements, if I have to repay back 1/5 of it every year, I would have 1/5 as a current liability and the rest of it 4/5 as a long-term liability. I'm never going to give you that situation because that's too much to take in. But in this one, since it's currently going to be due this operating cycle, it has to be classified as current. Does that help?
Yeah, but I have another question.
Yes.
So then, since adjustments can't be made until closing, when it becomes current liability for the long term, how do you do that transfer in the classified balance sheet?
What do you mean?
So
like, for instance, we'd be seeing this at the beginning of that year. So it'd be the end of that year where it's going to be due within the next year. Right. That would be listed. The next financial statement, you won't see it because it's gone now. So when you won't really be an adjustment because you're paying it. It'll be paid off before you even do the next statement.
In other words, at the beginning of the 4th year, it's what's the long-term liability. So
the beginning of the 4th year, it's still a long term.
So all the adjustments were already made at closing. But then 4 months later, it becomes current. So
But remember, we don't make financial statements till a year later, right?
So
we're not making a financial statement the next day for the next year.
So it's going to be listed and classified a year later on the next closing. Okay.
You got it. Awesome questions. All right, let's try another one. Where would you find the allowance for doubtful accounts under a classified balance sheet? Where would you find the allowance for doubtful accounts? Jackson? You think it came out okay? What's that?
Is this assuming that you know a client's going to get written off?
Nope. This just is you have an allowance for doubtful accounts balance.
You're expecting it back typically right under
Remember, they go together. So it just you have an allowance for doubtful accounts. Where would you see that? Everybody okay? Anybody else need time? No? All right. Perfect. It is indeed a current asset. Why is it a current asset?
If the accounts receivable is a current asset, and you expect it to be paid back within usually a month,
You got it. Accounts receivable is a current asset.
you're going to see it on the balance sheet directly under accounts receivable as less allowance for accounts realized.
You got it. When you look at a balance sheet, you're going to see accounts receivable, and then you're going to see directly underneath it what? Allowance. These two always go together to give us net realizable value. So if this is a current asset, which of course you had to know that to begin with, that why is accounts receivable current? We expect to receive it in 30 days or less. So that's definitely current. Therefore, these go together. It has to be a current asset. It directly relates to the receivable. It would not be a liability, so thankfully Only one person said liability, current liability, but there is a natural tendency to say it's a liability because it has a credit balance. Just remember that just because something has a credit balance doesn't mean it's a liability. What type of an account do we call the allowance? Anybody remember that? Contra. Maybe I should put that on the test for the final, right? What's the name of that? And it's obviously not under stockholders' equity because stockholders' equity has common stock and retained earnings. So, any questions on that? And then the last one, accumulated depreciation. Where do you see that on a classified balance sheet? Oh, well, might help if you could see that. Where do you see accumulated depreciation? Okay, why are some people saying stockholders' equity? I'm just curious. I don't.
Mixed it up with expenses, okay?
But expenses aren't on stockholders' equity anyway. Expenses aren't on stock. You don't see the word expense on stockholders' equity. Where do you see expense? Income statement. Remember, you only see the word net income in stockholders' equity. So, it's not E, because you don't see expense. And I'm not saying expense. Did I even say the word expense in that? No, I said, where do you find the account accumulated depreciation? So one person who's saying stockholders' equity, but it is not true. Now there's two. Now there's three. Okay, you guys are just playing with me now. The heat's getting to you. I hear you. All right, everybody all set? Long-term asset is correct. So, again, going right back to what we did with the accounts receivable. Accounts receivable is current. Allowance goes with it. What is why do I have accumulated depreciation? One of the things I talk to my students most of the time in my office hours is, when you want help, you need to do a problem. Do a problem, not an exercise. Do one that has not been assigned. Come to me. Let's talk about it. Because mostly what I'm going to do is just ask you questions. If you can't answer, then you know you don't know what you're doing. So for instance, in 8, I'm going to say, explain to me why we use accumulated depreciation. Most students can't explain it. So why am I using accumulated depreciation? What does it relate to? It relates to, let's say, equipment, some kind of property, plant, or equipment account. Why do I have to use accumulated depreciation? To find the net book value. How come I can't just credit the account? Why do I have to set up this account? Right, because nothing physically left. Nothing physically is gone from it. I'm just showing the use of it. So like AR and allowance, you have to find net book value. So if this is a long-term asset, what is this? Long-term what? It is not a long-term liability. It is not a liability. I don't owe something. Remember, it goes with equipment. They are together. They don't separate. So if equipment is long-term, so is the contra asset. They go together. When you look at financial statements, it will say accumulated property, plant, and equipment net. Property, plant, and equipment, comma, net. What is it net of? What is that saying it's net of? What does net mean? It's minus the accumulated depreciation. You notice that the is not under liabilities, it's under assets. It happens to be under long-term assets. Total current assets are above it. Then property, plant, and equipment is the first long-term asset underneath. So it says net. Net means you subtract something. What are you subtracting? Accumulated. Any questions on that? So those are things that you should be made aware of or be aware of for Chapter 9. The only thing I'm covering in Chapter 9 is classified balance sheet. That's it. And I'm asking questions just like I had up here on the test. Any questions? You feel a little bit better about that now? You didn't know you weren't feeling good to begin with, right? All right, so Appendix E, the situation we have in Appendix E deals with marketable securities. And marketable securities are going to be a deviation from, anybody remember what the very first concept was that I taught you? Anybody remember the very first concept? Begins with an H. It's historical cost. That's the very first concept I taught you guys. What does historical cost say?
Keep things on your books for what you paid for it.
So keep assets at what they cost you. Do not fair market value or appraise them at the end of the year. That is our primary rule that we follow for every type of asset. However, there are exceptions to the rule. There's always exceptions to things. And one of the exceptions to the historical cost concept is marketable securities. For marketable securities, we can actually fair market value them. They're not an appraisal. We fair market value them at the end of the year. What does that mean? Well, we first have to understand what is a marketable security. But it is an exception to the historical cost principle. It says that you don't have to record these things at their cost because you can go in the market and find out what the value is. And the only way that that's going to work and make sense is that everybody who looks at the market at the same time would pay the same amount for that asset. So marketable securities are assets. Anybody have any idea what they might be? What kind of asset they might be? Securities. So the first type of security, first type of things you're going to learn. You have extra cash. One of your main purposes in your business is to maximize shareholders' wealth. The best way to maximize shareholders' wealth is to take extra cash they have lying around and invest it. Now, we did talk a little bit about notes receivable. Where you have excess cash and you actually loan it out to another company. We're going to get into that in more detail in Chapter 10. But when you have excess cash and you loan it out to another company, what are they paying you in return for being able to borrow that money from you? They're paying you interest. So that's one way that we can maximize shareholders' wealth. If we have extra cash, we could loan it out to other companies and charge them interest. And we would loan it to companies based on their risk of repayment, non-repayment. The other thing we can do is actually invest in securities. And I'm hesitant to just say stocks because it's not just about stocks. There's many other things. So we need to understand what are these securities that we can actually buy. Debt or equity. Not working. Debt or equity securities. And they're normally from another company. So we may actually buy stock of another company, or we might buy some of their debt. And we're going to get into more detail about debt when we get into Chapter 10. This is a good segue to that, but just getting aware that companies may have debt that they actually sell to other companies. Likewise, the most common way for students to understand it is, think about debt in terms of governmental debt. You can buy bonds. You can actually buy bonds, government bonds, that pay you a stated rate of interest. Are bonds, do you think bonds are risky investments to get into? State or government bonds? Typically not. Why would they be less risky if you got into a government bond?
The only thing that'll keep you from getting your money is if the government is overthrown.
If the government's gone, then you don't get your money. So how often does that happen? Okay, so they're pretty low risk. So if your job is to maximize shareholders' wealth and maintain low risk, you're probably looking at debt securities that are from a government or municipality, meaning a state. Next, these types of investments that you're doing with your cash, you have to classify them in 3 different ways. And you're classifying them based on what's your intent. What was the intent when you bought the securities? There's 3 different types of intent. There's the intent to just hold that security till it matures. That's it. That's usually a bond. The second kind of security would be you actually are holding that. Anybody heard of day traders? That's not a very common term anymore, but when the IPO market started to boom in the 90s, day traders were really big. It was when they bought stock when it first got exchanged, and then they would try to resell it really quickly. So their goal was to make a profit in a really short period of time. That's really risky. What do you know that happened? Has anybody heard of what has happened to a lot of day traders? What's their lifespan? A lot of people have committed suicide, especially from the 90s, getting involved in this because they really thought they were going to make this big profit in a short period of time, and then they didn't, and they lost a lot of people's money, and they couldn't deal with it and end up killing themselves. Really, really risky. So if your company's getting involved in that, the Securities and Exchange Commission wants to know. So you have to classify that as a trading security. The other type, more common type, is just called available for sale. So you have a security that's available for sale. A security available for sale, meaning I bought stock in a company because I have extra cash and I'm just holding on to it until such time as I think it's necessary to sell it. So unless there's some major change in the market, like a new president comes in and they're going to do something different, I'm going to hold on to it. I expect it to make profits, I'm going to hold on to it. So the Securities and Exchange Commission's generally accepted accounting principles forces you to have 3 different types of security classifications. Held to maturity, those are your bonds. Usually what happens with a bond is you pay $100,000 for a bond. It's a 10-year bond. You hold that bond for 10 years, they give you 5% interest every year, and at year 10 you get the $100,000 back. So basically all you're making is 5% on that bond. But that's really low risk, considered a held to maturity. You're just going to hold on to it. When you see it on a financial statement as a held to maturity, you know that this company is low risk investing. Okay, and that's important to know. If you see a company that has trading securities, you know that they're a high risk. They're actually buying securities to make profits in the short term. If you see a security available for sale, they have extra cash, they invested in stocks or debt of other companies, and they're just holding on to it until there's some major reason to have to sell it. So it's not as risky. Does that make sense, the 3 classifications? just looking at, I already went through most of these, but held to maturity, debt, intent and ability to hold it till maturity. So you're not selling it in response to market changes. Again, that's why I say let's talk about debt security in terms of governments or states, because you just buy the bond, they pay you interest, and then you get your money back at the end plus the interest. It's how do you measure it? So the key thing is here, you have these three different types of securities. How are they measured? For a held to maturity, whatever it costs is what you held, is what it is on the balance sheet. So for instance, it's a $100,000 bond. When it's a held to maturity, that amount doesn't change. So it's just actually listed at cost. We don't have to use fair market value. Government bonds, you pay $100,000 now, 10 years you're going to get $100,000 back, plus you got 5% interest. So you don't have to have any fair market valuing for a held to maturity. They stay on the books at cost. So this is the easiest one to do. You spend cash. I'll just show you the entry. You transfer cash. You take your cash, let's say it's $100,000, and you're going to transfer it to a security account. And I'm just going to say HTM, not to be confused with the major. 100,000. So that's all we did. We transferred cash into a held maturity. That's all that happens with that information. It stays on the books for what we paid for it. So held to maturity. It's a bond. We pay $100,000. We get a bond. That's it. That's all you're going to do with it. Make sense? The next one, or trading security. So this is the riskiest one, trading security. This will have the same effect. So a trading security, this will be the same initial entry. Entry 1 will be the same thing for a trading. The initial entry is the same thing for trading. It changes at the end of the year, though, okay? A trading is more of a stock. This is a stock that you're actively trading in the marketplace, okay? So, just a little aside about the stock market. If any one of us goes onto the stock exchange right now and looked up Apple's stock price, we would all see the same number until the next second when it changes, because it's changing all the time because it's being bought and sold. But if we all bought the stock at the same minute, we would all pay the same price, and then you'd see the price change dramatically because we all bought at the same time the next second. Make sense? So if I can actually go to the New York Stock Exchange and pick out my securities and say, if I only had one security, I have Apple for $100,000. If at 12/31 the Apple stock is worth $120,000, what do you think needs to happen to this account? It's now 12/31. We all can agree that when we look at that stock market at the close of day, 12/31, we would all agree that that stock is now worth $120,000. And under this concept for marketable securities, there's an exception to historical cost when you can find fair market value and we all agree on it. So this isn't an appraisal. We all would agree on it. So this would be an exception to my historical cost concept. Because now at the end of the year, that stock has gone up $20,000. We can all agree that it has gone up $20,000. Have I sold it? No. But I'm saying that the value of it has increased $20,000. Would you all agree with that? That you could all go on the stock market, you could all agree on that one point in time what that amount is. If you can do that, then you can fair market value. You do not have to follow historical cost. So what does that mean? That means that we are going to need to increase this account by $20,000. That also means there's an effect to what? What's the other side of this effect, do you think? Maybe a temporary account?
That's not revenue, though.
That's not revenue. I like it. Anybody have other ideas? Anything else? So think about this. You have an asset that's increased $20,000. Has your wealth gone up? Your wealth has gone up because if you sold it at December 31st, you could have gotten 124 instead of 100. So, you do increase owner's equity. There is an increase here, okay? And we call that increase, did we realize a gain? That's my first question. Do we actually realize a gain? Realize means we have cash. No. So we didn't realize a gain, so we're going to call this unrealized gain. So we have what we will call an unrealized gain under owner's equity for this trading security. It's unrealized because I didn't sell it. But GAAP says if you've got a security that you can fair market value, every year at the end, when you make financials, you fair market value it. You show your investors that you're holding this stock and the value has increased, or it could have decreased, right? It could have decreased and I would have an unrealized loss. But if an investor sees the words unrealized, what does it tell them? What does it tell them about the security? It wasn't sold, correct? So you know just by being an investor and understanding these concepts, if it says unrealized, it has not been sold. The other thing with a trading security, it's under owner's equity, and for a trading security, I'm just going to label this TS, trading security, it's on the income statement. It's actually on the income statement. So this unrealized gain, this $20,000, will show up on the income statement. So if I'm looking at a balance sheet and income statement for a company with trading securities, I'm seeing an increase in that asset, and I'm also seeing an increase to net income. But the increase to net income would say unrealized. So we understand that there is actually being trading securities. So I can make an understanding. If I only saw the income statement for this company and I saw the words unrealized gain, I would know that they have marketable securities that are trading. Risky. They're risky. Yes?
So that $20,000, that's not lodged until the very end of the year?
Yep, we don't do it until the end of the year. So it's like an adjustment. We look at our assets, we say, are they correct? Oh, I have trading securities now. I can fair market value those. Remember, why don't we fair market value property, plant, and equipment?
Because there's no actual agreed upon value.
Yeah, there's no stock exchange for this. You just have to get appraisals, and those are opinions. The stock market's not an appraisal. It's not an opinion. It's what they're actually selling for. Is everybody with me on that? So looking at the recap of a trading security, if you have the slides, you're looking at those, but recap. They can be debt or equity, usually of a company, debt or equity of a company that you can easily trade on a stock exchange. They have to be easily traded on a stock exchange. You can determine their fair market value by looking at the New York Stock Exchange or NASDAQ. So we all would agree you can find out that fair market value. They're classified as trading because they are held to be sold in the near term. Day trader, very quick. Our intent is to make a profit in this current year. That's our intent. Remember, this is all about intent. So they're actively and frequently traded profit, meaning we want to show it on the income statement. Our intent is to make a profit, so show the unrealized gains and losses on the income statement. That's a really key one right there. Actively and frequently traded profit. Notice it says profit, meaning you will have an unrealized gain that shows up on the income statement. Your intent is to make a profit, but you could have a loss, unrealized. They are measured at fair market value and classified as, does it make sense they're classified as current assets? Why are they classified as current assets? Why is that? We expect to buy and sell them in a year. What about held to maturity? What do you think those are normally classified as? Long term, because they normally are multiple year bonds that we're buying. Unrealized gains and losses, like I just showed you, that T account, they are included in net income. So this is just the recap of what we've done. Any questions on that? Only one more classification, and we're basically done with this chapter. I will continue looking at it on Thursday, too, though.
Greed, for lack of a better word, is good.
What's that?
Greed, for lack of a better
Yes.
word, is good.
The last one is available for sale. So I want to look at the same exact thing. Whoop. So you guys have the same exact scenario here, except that now these are not held to maturity. They are not trading. They are available for sale. I'm just abbreviating. Does that make sense? Available for sale, AFS. Available for sale can be classified as current or long-term depending on what you're doing. Normally they're long-term, and they're just securities that you're holding. There's no intent to make a profit in the short term. It's just, hey, we have extra cash and we're holding on to it to make gains over the life of the time we have this extra cash. Same exact information. 100,000 is what you started with. If it's Apple, let's say it's still Apple stock that you're holding, and it's still $20,000 increased at the end of the year, we'd still have the same exact entries here. It increases 20,000. So the value of that Apple stock at 12/31 is 20,000. This is an adjustment, just like we were doing before. This does go to an unrealized gain account under owner's equity. There's one difference, though. It is not on the income statement. Remember, beginning retained earnings plus net income minus dividends. What else? Does this look familiar to what we did at the beginning of class today? Beginning, what is this? Is this retained earnings under owner's equity? Beginning plus net income minus dividends. So if available for sale is not included in net income, it has to be included somewhere because it's under owner's equity. We would bury it under retained earnings. So like we saw stock compensation at the beginning of this class, we'd also see something like this. It's actually reported in comprehensive income, which we're not really going to talk too much about. So we bury it underneath retained earnings. It is not included in net income because our intent is not to sell it in the short term for a profit. Give me 1 second and you guys can go. So we have debt, again, debt or equity securities. Everything is the same on this slide as it was for trading except for one thing. It is separately stated in owner's equity. I'll be saying it's really part of retained earnings, but it's normally part of comprehensive income. And I'll show you that on Thursday. So please look over these 3 classifications. Look at your slides. Come with questions. We'll finish this up on Thursday. Thank you, guys. Enjoy the weather. That's okay, don't worry about it. I took a picture of it and you don't believe me. No, it doesn't matter. It's not going to